Okay, we're live. Hi, everyone. Thank you so much for joining us. My name is Kassie. I am a partner with Blockchange Ventures. We are a New York-based venture capital firm. And I'm going to have all three of our panelists introduce themselves, tell us which fund they're with, and how you each got into cryptocurrencies. Paul, you want to kick us off?
Yeah, sure. Thanks a lot, Caroline. I'm with Pantera Capital. My name is Paul Varadatakit. I've been investing in cryptocurrencies for the last 4.5 years with Pantera. Pantera started off as a global macro hedge fund started by Dan Moorhead, who used to be CFO and head of global macro trading at Tiger Management. For the last 5 years, we've been investing into everything crypto and blockchain related. That means that our primary focus is basically three strategies. We have a venture capital side that invests into equity, companies like Circle and Ripple Labs, like seed rounds. And then we also have an ICO fund that invests into just pre-sales. So think of it as the early stage strategy for currency investments. And then we also have a later stage strategy for token investments, investing into cryptocurrencies early on exchanges using data and quant and algorithms and machine learning. So those are our three strategies. I mainly on venture and ICO, so everything that's been early stage, and I've pretty much sort of sourced and executed most of our investments. And outside of that, in terms of how I got into crypto, I started getting into crypto in 2013. Some of the guys at Lightspeed, they were doing some early stage investments, and I thought it was pretty crazy at the time. But the more that I read into it, and it was sort of like a perfect transition when I was like looking for my next thing, the more that I just thought that there was just so much potential and so much asymmetric returns. And, you know, I figured that this is something that I wanted to really just dive into and really just kind of use my experience in venture capital to really just kind of push this space forward. And so, yeah, for the last 5 years, basically been looking at just this.
And hi, I'm Cindy. I'm with VY Capital. We're a traditional billion-dollar VC fund based in San Francisco, and I cover cryptocurrency and blockchain exclusively there. And VY has been investing in the crypto space since 2014. So our whole fund isn't cryptocurrency, but a significant part of it is. And so we started out by taking a principal position directly in Bitcoin and then added on some of the other liquid traded tokens after that. And then I focus on early stage equity investments, so seed stage, Series A investments in the space, as well as the early stage ICO pre-sales as well. And I probably personally got into crypto in 2014 because I had a friend who was really into it, and then he just talked about it nonstop. So I was like, okay, I'll just buy a little bit of this Bitcoin and sort of like see what happens. And I was working at another venture firm back then that didn't invest at all in crypto, and then I joined VY, and that's all I've been spending my time on since. And it's just been absolutely amazing to see the space evolve and all the super interesting ideas and like future potential that's come out of it.
So we had Kyle Samani as our last panelist. He's the managing partner of Multicoin Capital based in Austin. He dropped off. Seems like he's having some technical difficulties, but in the meantime, I'll just go through. I'm going to ask the panelists some questions. There is as I'm sure you all know by now, there's a question and answer function on this platform. So feel free to ask and vote on some questions, and we will try to integrate them as we go on. Okay, Cindy and Paul. Oh, Kyle says he's here. Okay. All right. Can you guys see Kyle? No. Okay. Well, while we're waiting for Kyle, Cindy and so there are a lot of strategies in crypto investing, you know, anything from a passive index to traditional venture. Can you, I know you both touched upon it, but can you each speak to which strategy your fund is employing and why that is the winning strategy in this space, in your view?
So I think there's actually a lot of winning strategies, and investors should actually specialize in areas where they can generate alpha and perform better than other strategies. So for example, for us, we have a traditional venture capital firm. Everyone at our firm has invested in very long-term kind of buy and hold strategy for like the last basically over their careers. So we're not actually really necessarily traders, but there's a lot of people who are really good at trading and will sort of like, watch the markets and watch fundamental indicators and trade crypto in and out. So for example, for us, because we have a firm where we don't necessarily have to worry about return on capital like in the next month or watch day-to-day returns, we can invest in an idea where it might take 5, 10, 15 years to get to fruition. And that was sort of the thesis behind us investing in Bitcoin in 2014, where back then crypto was still a very small industry. It was almost like a cottage industry. And then the main asset in the space was Bitcoin. And we're like, we don't really know necessarily when crypto will catch on and become mainstream, but we're able to sort of identify an investment that we find really compelling and wait for it to play out over the next coming years, however long that takes. And that's a lot of the strategy that right now I employ when looking at some of the more recent ICOs, where a lot of them will focus on scalability, or they'll focus on privacy or a particular issue that they do better than other projects out there. But we don't actually know how long it'll take for that to come to fruition. And we're perfectly okay sitting back and supporting the entrepreneurs and investing in that project and taking a much longer term approach.
Great,
Yeah,
thank you.
I'd echo what Cindy mentioned. It really depends upon, your background and what you're familiar with and where you think you can really generate alpha or add value or provide a competitive advantage. For us early on, Dan coming from Tiger Management and actually being a former trader at Goldman Sachs, his background was, wow, currencies. There's a lot of potential in this new currency, especially for store of value and cross-border money movement. What do you do as a speculator when there's a new currency? You buy and you hold it. So that's why he started the Bitcoin Fund. That was in conjunction with a few of the partners at Fortune's Investment Group, Benchmark Capital, and Rivet Capital, where it was like, hey, well, this is going to be our first avenue to get exposure to this space. And then, as he started, meeting a bunch of entrepreneurs in this space, he figured that there was a lot of opportunity to seed some of those entrepreneurs, because as there are companies and infrastructure and applications that were built on top of blockchain and cryptocurrencies, then that's going to really drive up the price. So he did some angel investments, but really, felt like there was a way to be more professional about this and raise a separate fund focused just on blockchain venture. So that's when I came in. I brought in my venture capital experience and really just kind of hit the ground running in terms of investing into companies. With the brand that we have generated by being thought leaders in our investor letters and things like that, that has really helped us gain access to some of the more compelling deals, both on the venture and on the ICO side. I think that's why we feel like that is our competitive advantage. Is really, we've built up a great brand. We've demonstrated a good track record and ability to add a lot of value to our companies, where as we are going and trying to unsurface new investments, they ask us why you want to take capital from Pantera Capital. We can really speak to that. And then, of course, we've sort of amplified the team recently with adding Joey Krug, one of the founders and chief architects behind Augur, which is actually launching, I think, as we speak. He's been really helpful in terms of analyzing on the ICO side. Having done one of the first ICOs on Ethereum, he could really speak to, what it takes to, sort of write the right smart contracts, the process to kind of go from, idea all the way to actually now launching a product. And then the last strategy that we have is the quant strategy. And that was sort of fortuitous because, a couple of the engineers or a couple of tech guys on our team, they actually had built quant funds in the past, but for the public markets. So as we were doing sort of R&D alongside, our ICO and our venture strategy, they saw that there was a lot of opportunity, a lot of inefficiencies in the market to actually use quant to be able to make some good alpha in this market. So that's why we generated the quant fund.
Got it. Great. So it sounds like you're both supportive of a somewhat multi-pronged strategy to crypto investing. So, in venture and in investing generally, I know there are a lot of entrepreneurs in the audience. We hear so often that the only way to raise money is through a warm intro from a credible source, through another investor, from an entrepreneur in your portfolio, and that investors don't pay attention to a cold pitch. I get cold pitches all the time, and there are some that grab my attention. So I want to hear from each of you, what would make you pay attention to a cold email in your inbox or a cold phone call? What grabs your attention when the pitch isn't coming from someone you trust and co-invest with, or an entrepreneur you've already invested with?
Yeah, I can start first this time. So, I think in general, we do see a ton of deal flow. And you're right. A lot of the ones that we do sort of take an eye out for are the ones that come from warm intros, especially other VCs. On top of that, other VCs that you've done deals with, you know that they have the same sort of thesis, and you can sort of already jump a few levels in terms of comfort. But, we have invested into, a few projects that have done cold emails. And, I think it's, without having sort of that initial comfort level come from a referral, you have to kind of look for it in other ways. And other ways may mean, sort of demonstrating, the investment business is all about betting on teams. Things are going to change all the time. So sort of the ability to highlight why, your team is special, why your team is well suited to tackle the problem that you're trying to tackle. And then, of course, just painting the picture of the problem itself. I think market size and sort of compatibility within the existing market is something that we look at quite a bit. So if you're already, we saw Nick Tomeno write recently on a request for startups. We do that all the time. Like, what are different types of startups that we'd like to see? So if the company itself can pitch the problem and the solution that they're solving, and it actually resonates with one of our theses, then I think that really sort of enhances the likelihood of us responding and saying, hey, that's exactly what we're looking for. You look at the team. And then I think the third thing is, what sort of traction do they have? Do they have any sort of demo MVP, or maybe some sort of community buy-in already? There's already examples of people using their product, being excited about it, engaged with it. Those are probably the first few things you can really highlight. If you don't have any of those, then better try to figure out some of those things and kind of put it together before reaching out in a cold email.
Yeah, and I agree with a lot of what Paul said. And I actually think that he's highlighting not only what's good qualities to look for in a cold email or a cold pitch, but also great qualities of projects to look for overall. So things like, do we think that technology is really special in terms of what you're building? Is the team very compelling? What is your vision? Like, what kind of community you've built up? Those are all factors in an overall excellent crypto or blockchain investment in general. And so if you can really highlight some of those in the email, that'd definitely be super compelling. And I also think I have no problem with cold pitches or cold emails at all. And in fact, it shows a certain level of hustle to be able to go out and find you on LinkedIn and write a personalized email or note to you, or figure out what your email address and send it across. And it also shows, on the flip side, it also shows a certain amount of hustle and connections in the industry to be able to tap people around you to write a warm email to the investor that you want to reach. So I actually think both sides show a certain amount of initiative that you want to take as entrepreneurs. So I fully encourage people to reach out to any of us, whether on LinkedIn, Twitter, etc., over email with any sort of ideas that you have if you are very seriously fundraising for the space.
And a lot of people are asking for advice, it seems here, on how to pitch a VC, what investors are looking for. Can you guys speak in a bit more detail about your due diligence process? Once you've met an entrepreneur who's been introduced to you or whose cold email you've responded to, what sort of things are you looking for? What information do you need from them?
I can summarize what a bit of what we covered before. So a lot of times, the two most important factors, I would say, are tech and team. So one is the technology just kind of copying what's already out there, or is it like something really special and truly novel for this space? And the second aspect is definitely team, because there are a lot of times where someone might write a really interesting paper, or like they might pull a team together from, like a hackathon that they met. But we would really like to see a demonstrated history of not, first-time entrepreneurship is totally okay, but also a demonstrated history of this group of people working together in the past. So if you just met someone through a hackathon like 2 months ago and you're currently fundraising, that might raise some red flags, because like we don't actually know how you're going to interact in like a few years down the line. And then also references are important. So like if we get to the final stage of an investment, we might, talk to people that you've worked with in the past. Also, in terms of technical due diligence, we may not be like the foremost expert on that particular type of tech. So it's a lot of times bouncing ideas off of other crypto investors, off of people who are more academically inclined and are very familiar with the space. But I would actually say those are probably the two most important diligence items.
Awesome. Okay, Kyle is back. So we're going to have Kyle, can you introduce yourself? Tell us a bit about Multicoin and your strategy and how you got into crypto.
Hey, Caroline, thanks so much. Sorry, everyone, I've been having some internet problems. So my name is Kyle Samani. I'm a co-founder of Multicoin Capital. We're a crypto fund based out of Austin, Texas. I happen to know all three, Cindy, Caroline, and Paul quite well. So good to see you guys. Multicoin invests exclusively in crypto. We invest kind of a full life cycle, all the way from someone with an idea and a PowerPoint deck, all the way through Bitcoin. We're not afraid of kind of technical risk, yeah, we spend all of our time in the space. Generally, we bias towards harder tech stuff than kind of consumer applications, but we've done 1 or 2 consumer applications. But we really like hardcore technology infrastructure in the crypto space.
Awesome.
Yeah, I don't want to interrupt. Let's keep going. I know I'm a little late to the party.
Okay. So, us in the crypto investor community, we all, or most of us, have access to a lot of the same token deals. If we're investing in equity, rounds tend to be oversubscribed. What do each of you feel that your point of differentiation is to founders? Feel free to, whoever wants to go first.
Yeah, I can go first.
I'll jump in, Caroline.
Oh, you go.
So, one thing we really pitch to the founders is we want founders to know, that we're entrepreneurs too. So both myself and my co-founder, Tushar, have both started companies in the past. We've both been through the trenches, and we both did it in a pretty ugly space. We were both in the health IT space before, and it was not easy to raise capital in the health IT space in 2013, 2014 as first-time founders. Today in crypto, capital is a lot more accessible than it was when I was an entrepreneur. So we have that empathy is pretty strong, and we know just how hard it is and kind of all the hard work it takes. The second is we are really deeply technical and really focused on helping entrepreneurs understand, not just like, we're not going to help you build your code, but we're going to help you understand the strategy of like the landscape of where value is going to accrue, and help position yourself, your messaging, and the right partners to bring that to fruition. Because we're super focused in the space, we can really help do that in a way that most investors can't, although Cindy and Paul here and yourself, Caroline, certainly are just as focused as we are.
Yeah, I guess I'll jump in. So I think the way Pantera pitches itself is, we've been doing it for the last 5 years. So, as a firm, kind of getting in this space early, almost being a startup company while doing that, being a team of 5 people at one time. We started with 20 people, then we went down to 5 because the space was so bare, and then now we're back up to 30. So again, we've been through the ups and downs of the space, so we're not afraid to sort of, do whatever it takes to sort of, help the space, help our entrepreneurs. That also means that, we've seen a lot in the space, and we've invested a lot, and we've helped a bunch of our companies. So that's a lot of experience right there. That's a lot of track record. That's a lot of branding right there too. And then in terms of our, the number of investments that we've done sort of 80 or so investments. So that means that a lot of those companies can really, be synergistic with each other. So you sort of enter in sort of a Pantera portfolio of 80 companies, and there's a lot of business development, there's a lot of learnings that can happen. So it's kind of a growing family, a growing community over there. And then the second thing that we probably highlight is the fact that all of the main partners are extremely complementary, but extremely helpful. So you have Dan, who comes from the institutional hedge fund world. He's got a lot of the connections over there in terms of just really understanding deep finance. Myself, I've been in VC for the last 8 years. I've done most of the sourcing, the executing, and most of the helping of all of our portfolio companies. So that means all over the world too. So connections within the space, domestically and also globally, insights from sort of different companies, war wounds in investing, that sort of thing. And then Joey, who's deeply technical, he actually can write a bunch of smart contract stuff, demonstrated with Augur. Also a lot of entrepreneur experience, starting that company early and now going through an ICO and a launch. So there's a lot of operational and technical sort of help that he can provide. So that's kind of the full package, everything from the insights, the technology, and the sort of community and branding.
And the other thing I want to emphasize for entrepreneurs who are looking for investors is that capital, particularly in this space, is very accessible, and sound advice is actually more rare than capital. And so the type of investor that you want to partner with are people who have your back and are in it for the long term, not just people who, might be attracted to like a particular type of return that might be generated in a very short period of time. And so especially as you're thinking about building a project and growing over the next few years, you have to think about a lot of things beyond just what is the original technology you're starting from and what does your team look like today. There's a lot of scaling problems that you might come across a few years down the line. So there's growing pains in terms of growing the organization, scaling, treasury management, like strategy for future fundraising, because like this might not even be even if you raise a lot of capital today, you might run out in a couple of years and then you might need to go back out on the market and talk to investors again. And so our take is that we're very long-term investors and we will be partners and aligned with you for the long run. We're also great sounding boards in terms of giving strategic advice because everyone on our team has worked in venture for a number of years. And so just understanding what's going on in the market and understanding what you're going through and to be able to act as that point of giving strategic advice and also connecting you with other people in the space, whether that's in crypto or in the legal world or in other parts of tech that can provide you with these types of resources and advice as you grow and scale, whether it's a company or any kind of project that you're working on, I think is super valuable.
Great, thanks, Cindy. I think that's a really good insight. We like to tell our entrepreneurs that we are courageous investors and to look for courageous investors, the kind of people that will be there when the hype is not there. So I think, we've heard a lot from everyone about what they look for in investors and some advice to what they look for when investing and some advice to entrepreneurs. This is a question from our participants. On the flip side, are there any red flags or, anything like that where you would not invest or something that might scream fraudulent to you? Kyle, we'll start with you.
Yeah, so I think one of the key things we look for is just really clarity in communications, reaching out. So a lot of investor pitches we get of just a lot of buzzwords, AI, or blockchain 3.0, 4.0. If you try and use any of those terms that try and kind of force them in where it's not really necessary, that's usually a pretty big turnoff for us. I really just like teams that are really focused on, hey, here's some technical problem and here's how we solve the problem. And I really like kind of that clarity of focus. So that's probably the most important thing. In terms of like bad behavior, I mean, like it's usually not too hard to tell. Most of the pitches we get that are just copy pasted, right? If you're just copying and pasting the same thing and sending it to many investors, you're almost guaranteed not to get a response. And like we kind of just skip those and ignore those. It's pretty clear when someone has actually bothered to research who we are and reach out to us in a personalized way. And if it's just copy pasted, yeah. For sure.
Cindy?
Yeah, and then from a broader perspective, also in terms of evaluating crypto projects or blockchain projects, a couple of questions that you want to ask. One, do you need a blockchain? Another is, do you need a token? Because a lot of times people are raising in a fashion where they say, we're going to do an ICO, we're going to have this token because this is the format that we're fundraising. And a lot of times it might even make more sense for that company to raise in a purely equity structure because what they're building might not need an inherent token. And then the third question would be, are you forcing functionality into a token that actually increases friction? Because a lot of times the appeal of having a token or investing in crypto projects is you are actually taking this new technology and reducing friction due to like current inefficiencies in the way that our world or our transfer of value is set up. And so if you have a token because you might think it's an easy fundraising mechanism to do an ICO, are you actually designing the incentives around the token that it makes sense for other people to want to buy, use, transact with the token, and for investors to hold on to it? Sometimes we'll see situations where people force functionality into a token that like shouldn't necessarily exist. Like sometimes a token exists for payments when you're better off using like the native token of the blockchain that you're building on top of. In some cases, a token forces kind of like this holding function, whether that's through artificial kind of like incentives to get people to hold the token for longer because like it for some reason increases value. And I think in that case, it's because people believe that reducing velocity of the token actually makes it more valuable. I think that is a thesis that's yet to be seen. And so if you are sort of introducing these artificial constraints just for the sake of having an ICO, those are some huge red flags.
Yeah, I think both Kyle and Cindy both talked about pretty much two of the main ones. I mean, again, like token usage, tech teams. I think for us, I mean, focus. A lot of people. There's so many different opportunities to do things in this space, and some people want to do everything. I think for us, I mean, it's going to be a long journey. We're so early in this that you kind of should take a step-by-step approach and not sort of try to paint everything that you're trying to do, but basically just kind of have everything, be more focused on what's going to be this first step. How are we going to dominate this well? This is going to be the second step. This is going to be the third step. I think that's something that, we really want to preach in this space is that like, you don't need to raise that much money. You don't need to do everything, but you just need to do one thing and do it well. Outside of that, I mean, it's looking at if there's no tech team even present on the first few members of the executive team, then that could be a red flag. Over-promising millions of transactions per second. I mean, sort of things that just we know aren't feasible that kind of are put on there more for like sales tactics. I mean, we can kind of catch those things and just kind of. I think that the last thing would be looking at the problem that's trying to be solved and looking at the team behind it and seeing if there's any sort of relationship in terms of seeing whether that team has the right background to solve the problem that they're trying to solve.
Great. So you've all mentioned the importance of great teams as something that you look for and something that's important to the success of a project. Historically, the other thing that investors looked for was tech moats, but we're in this new paradigm where people don't, or projects founders don't own their intellectual property. Projects are code is open source. What other barriers to entry are you looking for, or are you not really looking for barriers to entry anymore other than the aforementioned awesome tech teams? Paul?
Yeah,
so
I can start
off. One thing we look for typically is a way to get network effects going. And depending on the kind of the kind of token it is, there's different kinds of network effects that can accrue. So, for example, if you look at things like smart contract platforms, so things like Ethereum, Definity, EOS, Cadena, these kinds of things, in these systems, our hypothesis is that there's going to be a network effect around using it as a medium of exchange and as a currency within these respective ecosystems. And so, one thing we're looking for when we make those kinds of bets is, after not just once we make the investment, we're looking to track the blockchain and see. Is there more usage happening? Are more people building applications and using them and conducting commerce? And if there is, then we believe that's going to kind of aggregate support our hypothesis, and then that snowball is going to keep rolling, and we'll keep getting more network effects. So that's one of the major things we look for is ways to get network effects.
Yeah, I'd say that's exactly what I was going to say. Network effects, and it depends. I mean, if you're building a new platform, then it's can you provide? I think across whether it's more of an application platform versus sort of a new blockchain, at the end of the day, it's all about messaging and it's all about usability. So companies that can focus on both of those and be able to do it well, I think will sort of create good network effects for people to onboard onto the platform and stick on the platform, and then build sort of a network effect around usage. So I think that's one of the things that we tell our companies is, technology and communication right now is extremely complicated. If you can figure out a way to communicate with developers, communicate with mainstream audiences if you're building a consumer product, businesses if you're trying to do business development partnerships, get them to kind of understand what you're doing and be passionate about it, those network effects will come.
Yeah, and to sort of add on to this, I completely agree that in some cases, a lot of the tech is open sourced, and so the tech might be easy to copy, but the things that aren't necessarily easy to port over from one project to another, if, for example, if you just fork the code base on GitHub, is the community that's been built up around the original project, and also the brand. And a lot of times the community involves like the developers, businesses, et cetera, that are built on top of the original project. And also in terms of the I guess from thinking about the more technical perspective, even if you fork the code base that's currently existing on GitHub, if the technical team of the secondary project is not as strong as the first project, as new updates are rolled out on the original code base, sometimes it doesn't, like, it's not trivial necessarily to copy it over. And so we're also looking for the fact that the technical team working on the branch off or the fork or sort of like that, the split part of that project is just as strong as the original one. And then along with that, I agree with you that a lot of times the code base for these projects are open source, but we are starting to see some more examples of development teams saying, hey, we're going to open source the bulk part of our code, but for some parts of it, we're going to leave it closed source because we have a monetization plan behind not publishing some parts of the code that we want to take advantage of. And I know that we are all very pro decentralization, but we're also very pro having like a working business model. So we are okay with that in some cases.
Great. So I'm seeing a lot of chat, or I was seeing a lot of chatter here about ICOs and hype and gold rush. Can you guys give me your perspective on the regulatory landscape right now and how it affects the methods of fundraising projects are using? Is it the right time to be doing an ICO? Should companies be pursuing equity rounds? What do you think? Cindy?
Yeah. So for the current regulatory landscape, it's definitely a lot more scrutiny than it was 4 years ago or 5 years ago. So right now, what the regulators are watching out for is that their main incentive is to make sure that regular, normal consumers aren't screwed over by investing in something that is fraudulent. So they're very focused on consumer protection right now. And they also, and a lot of times the way in which that is expressed is through securities laws, because the fundraising for a project that has not yet been developed technically falls under the category of a security. And if you're selling a security, you need a lot of licenses in order to be able, to promote it or to do certain things in terms of fundraising from that perspective. And then if you're an investor investing in a securities offering, you have to either actually be an accredited investor or reach some threshold for proving that you're not, like an everyday retail investor that can be scammed or taken advantage of. So, but the other thing that the regulators need to balance is not stifling innovation, because the issue is if, for example, in the US, we're very strict about ICOs and we say that they're banned, et cetera, then a lot of these projects might go to overseas jurisdictions in order to raise funding or to set up their project. And then in that case, the current jurisdiction that we all live in might lose out on technical talent. So regulators, they sort of have to thread the needle between protecting consumers, but also not stifling innovation. And in that case, I personally don't have an issue if a project decides to raise an equity or ICO or raise right now as an equity round because regulations aren't clear, but then have some clause in the term sheet that says, if they issue tokens later on, the equity will convert in some way to crypto tokens, et cetera. That might be the way that I've more recently seen projects do it, whereas maybe like a year ago, more people were willing to raise, just as a pure token sale.
Yeah, definitely. I've noticed that trend as well. Paul or Kyle?
Yeah, I think, I I think Cindy for kind of giving the background of all of that and really why it's so important for us to, for the US to kind of figure this out. And of course, for projects themselves, I mean, I think if you don't know what you're going to do in terms of, and that's also another topic too, is like, if you don't even know kind of what your token is going to be used for, then likely your project probably doesn't need a token. But sometimes, again, it's just complex. You want to make sure that you get it right. So raising a convertible note or raising equity round first, and then kind of figuring out how that ties to the token sale later is probably a good idea. Gives you a little bit of capital, get your team together, build, an MVP, get your white paper together, because all of that does cost money. Again, with more legal scrutiny, your legal costs are going to be, higher than it was before. But, if you are, and you have the ability to do so, and you want to go out there, you have a pretty clear plan of what your token is going to be used for. It's sort of a new blockchain or something, and the use cases are a little bit more straightforward, and you have the ability to raise a large amount of money, then you may want to go straight for a pure token sale. I think other strategies that people are employing these days are knowing that the United States and securities laws can be onerous, blocking U.S. entities and raising mostly or all from international investors or people with international entities, and doing all of these sales privately and not actually opening up to the crowd. So that's becoming more common too.
Mm-hmm. So backtracking to a few minutes ago, Cindy mentioned that we're seeing projects now that keep a portion of the IP private closed source. Bill has asked, how long do you think that it's okay for a project to protect its IP, i.e. file patents or keep the code closed source? Anyone can jump in here. And do you think that it's detrimental to building a community?
I think it definitely depends on the situation. Like, it's hard to have a hard and fast rule, but I would say like maybe a general guideline would be, if you put enough code out in the world in terms of open source for other people, like developers, to play around with, build on top of, and they feel like you don't necessarily have complete control over like exactly what they are building on top of. Because the worst thing, I guess, for a developer who's building something on top of your blockchain or your project is for you to be able to unilaterally make a change that affects their business one day. And that sort of like goes against the ethos of decentralization, where like all stakeholders in an ecosystem, including the users, developers, miners, etc., a lot of those stakeholders have input in addition to the original coin developers. And so where I think it gets detrimental is that if people who are using the code base that you're building on top of feel like they don't necessarily have a say. And I think it's actually okay to keep parts of it closed source in terms of it might be adjacent to the core blockchain that you're working on. So an example of that might be if you're developing a blockchain and open sourcing the code, but then the adjacent business that you're building is something that, you're taking, you'll be able to like process transactions on top of it and take a cut of it, or you're developing like specialized mining equipment for it, for example. And so I think in that case, it wouldn't necessarily be detrimental to the business that those developers are building, but it's just something else that you're sort of doing on the side to run your own business and be able to monetize by yourself.
Great, thanks. That's super helpful. Okay, so what's a contrarian opinion that each of you holds about the crypto space? Kyle, we will start with you, because I know you'll hold many.
So, all right, one view I hold been developing recently, and I have reasonable conviction in now, is that in about 2 to 3 years, privacy will no longer be like a trade-off to get. It'll be basically a feature that is just given for free, so to speak, and that any chain can incorporate in a pretty trivial and easy way. My sense is that's about 3 years away from happening. I think today, given the challenges of implementing privacy in a meaningful way, that's not considered a free feature, so to speak. but I think in about 3 years, it'll be a trivial thing to integrate into kind of any major crypto project.
Yeah, I actually agree with Kyle on that. I think someone posed that question. I'm on the same viewpoint as that. I think something else. It's probably contrarian in terms of most people's investment theses, but I think for us, like, we're still excited about investing into decentralized applications themselves, and we're happy to invest into scalability projects, but we've been really picky about those ones. I mean, I think since our ICO fund is focused just on pre-sales, we want to be diversified, but then also feel that it's going to take a lot of time to build these applications. And, we know for sure none of them are ready to actually, sort of get out to scale. But, as we've seen from Augur and how long it sort of takes to even just develop the contracts and the UI and the UX and security for some of these decentralized applications, if it makes sense for a product to be decentralized, to enable a new market or to reduce fees from incumbents, then we'll be happy to make those investments. So I'd say number-wise, most of our investments are in non-scalability projects, but dollar-wise is probably the other way around.
I have sort of a contrarian opinion in terms of scalability projects, particularly as it pertains to smart contract platforms. So a lot of the more recent pitches and ideas that have been super compelling that we've been seeing have been on projects that are honing in on like the scalability issues of Ethereum and Bitcoin blockchains. And they say like, we're faster, we're X thousand transactions per second, we're more scalable, et cetera. And so a lot of times like investors and even we will sort of like spread our bets across these projects because we don't know which one will win. And I've heard from other investors that one of the reasons why they're investing in a lot of these is because they think that there'll be almost like this multiplicity of different tokens and smart contract platforms, and they'll all be talking to each other, et cetera. I actually think that there will be a convergence on the dominance of a single, maybe one or two smart contract platforms. And the reason is because there's a lot of, I guess we mentioned earlier, network effects, but also brand reliability, developer kind of capture that goes along with having a particular dominant smart contract platform. And so even though while we're spreading out our bets with multiple of these, I do think a lot of them might not be around in 3 or 5 years from now, and we'll all probably just be using one or two main ones.
Great. So in addition to or other than privacy and scalability, is there a trend or innovation happening in blockchain right now that really excites you?
One recent thing that people have gotten like super excited about is non-fungible tokens. And basically what these are they are tokens where each individual one is a different, separate, distinct asset. So you can have like your own distinct, for example, CryptoKitty that's very different from someone else's. So you can't like one Augur token is the same as any other Augur token, but a CryptoKitty is distinct and different. And one of the reasons why this is a pretty exciting recent development is because the space of utility tokens, a lot of times, it's sort of, you run into issues with like, is this a security or not? And so people have been sort of like cautious because of the regulatory aspect. But for non-fungible tokens, because they're digital assets, I'm not a lawyer, but my understanding is they might have a different classification where they're not necessarily considered securities, they're considered property, et cetera. And in that case, some of the innovation that people were very excited about in terms of like utility tokens, et cetera, some of that might be pushed more towards the non-fungible token and digital asset space.
Non-fungible tokens is a great one. Kyle?
Yeah, I think the thing I'm kind of most excited about right now is all the infrastructure that's being built out to support end user applications. I've been working on a post, I think I'm going to publish it tomorrow, kind of outlining what I call the Web3 stack and kind of just showing all the different parts and pieces. And one thing that became very clear to me as I put together this post is when I actually draw the Web3 stack out, none of the pieces, like the stack isn't finished. And so you've got people trying to build end user applications on top of infrastructure that is not finished yet. And so the thing I'm most excited to see over the next 6 months is really seeing the like core pieces of infrastructure, at least like 1.0 of every piece, so that you can start to get more meaningful end user applications. But for now, yeah, it's still a major challenge. So I'm most excited about getting the infrastructure together.
Yeah, I mean, I think I agree with both of those guys. We've invested into NFTs pretty recently, non-fungible tokens, and we continue to invest into infrastructure. I think one big trend that we're looking at quite a bit is security tokens. And, again, I think we're all actually investors in Harbor, and that's a platform to kind of help issue security tokens. And again, it's going to start off on infrastructure. There's going to be more types of those companies. There are going to be more types of security token exchanges. There are going to be more types of things around reg tech around that, and the issuance, et cetera. So I think that's going to be a tremendous market. I think that's going to be a tremendous market, probably even larger outside the United States than inside the United States. And then I think another trend that's happening quite a bit this year is there's just a lot of activity outside the United States. So you really do have to be plugged into China and Korea. A lot of the infrastructure that happens here is going to be sort of ported over there in terms of them also needing infrastructure. And at the end of the day, this is decentralized technology is global. But before a lot of the consolidation that Cindy talks about, I think there's going to be some more fragmentation around infrastructure, and then comes the consolidation. But because again, building community, a lot of that starts with sort of knowing the community itself and language barriers, et cetera. We're going to see a lot of that fragmentation, and we're going to be looking for those types of infrastructures outside the United States.
Great. And how about a specific project that you've either recently invested in or eager to invest in that's really exciting you? Kyle?
Oh man, I know I've got a couple I'm not supposed to talk about.
Well, now would be the perfect place to talk about it in front of 16,000 people.
Trying to think of one recently. We can talk about. Can you come back to me? Give me a second to think through.
Okay. Cindy or Paul?
Yeah. So Paul mentioned Harbor, which I think all of us invested in, but it's basically a platform for making sure that security tokens trade in a compliant way. Another recent one that I think at least Kyle is in, I'm not sure if Paul is in as well, is that I'm pretty excited about is MobileCoin.
We're in MobileCoin as well.
Okay, awesome. Yeah.
I love MobileCoin.
So on the theme of privacy and making privacy more accessible, this is a team that started the Signal chat app, and their goal is to basically make sending privacy coins like much more easy and accessible to the average everyday user than privacy coins are currently set up.
Yeah, so one investment that, actually I'll talk about two themes that we've done recently. One that just got announced today, but we did a while ago, is Oasis Labs. I'm not quite sure who else is in that, but it's a really strong team. I've known Don for a long time, PhD at UC Berkeley. Again, they're using hardware for privacy, but then also have figured out ways for scalability. So that's a bet, I think. Yeah, there's quite a few crypto firms in that one. So that's an example of some of the themes that we've talked about earlier. And then outside of that, I don't know if we're supposed to be talking about venture, but we're looking at a few different types of exchanges still. Yeah, infrastructure. One that we've made recently in Asia, and one that we're making out here in the United States. The one in the United States is a derivatives play, and the one in Asia is just regular fiat to crypto. But I think, obviously exchanges are dependent upon regulations of what happens within a certain country. But I think that is a moat that exchanges can create, is if you are able to sort of have the reg tech expertise within your firm and be able to have the relationships with the government, with the banks, to be able to sort of create a barrier for some of the other entrants. So that's kind of a theme that we've been looking for with exchanges.
Great. Kyle, did you think of one?
Yeah, I did. So I'm thinking about Tari recently. So Tari is a project led by Naveen Jain, Dan Turi, and Ricardo Spagni, otherwise known as Fluffy Pony. And the reason we're so excited about Tari is a few reasons. One, the team is one of the strongest ones in crypto. Naveen is an awesome serial entrepreneur who's had a lot of great success before. and he's just an absolute bulldozer. I mean, if anything is in his way, like he will knock it down. Dan is one of the foremost experts in the ticketing space, and Fluffy Pony, of course. I mean, how many people on the planet have built a multi-billion-dollar blockchain that really truly works and is truly meaningfully decentralized? And the answer is there's like 5 or 6 people, and Fluffy Pony is one of them. And so, looking at this team together, it's an incredibly strong and diverse team across a lot of different fronts. And then they're going after a very specific use case, which is digital assets. And digital assets make perfect sense to me that they should be on blockchains. And so I think this team is going to really, really, really nail digital assets. And like where that blossoms from there, who knows? But I love their super tight focus, and the strength of the team is very impressive. So we're super excited. We backed Tari about 6 months ago, and it's been great to see their progress.
Yeah, I'll echo that. We also love Tari. I think it's one of the best teams in the space. So we're almost running out of time. I saw a lot of people want to ask you guys for advice about creating their own investment companies, getting started out as an investor in crypto. Can you each speak to some advice for not startup entrepreneurs, but startup investors in this space?
Yeah, I guess I'll go first. So I mean, Multicoin launched about a year ago, and we started from nothing. No one knew who we were when we got started. It's really, really hard to launch an investment fund. We got really lucky in a lot of ways in terms of market timing and a few other things. I would say my number one piece of advice would be really, really focus, know where you have an edge, and make sure you just triple down on that edge. It's way too easy to start trying to do deals in Asia and Europe and the US and trade public markets and do private markets. There's just no way you can do all of that with a 1 or 2 or 3 person team. If whenever you start, by definition, you start very small. Be super, super focused in how you're trying to deliver results, and kind of compound on top of that. We were very lucky, and we did that reasonably well, and it's worked out really well for us. So I recommend super, super tight focus for some new investors.
Great advice. Paul?
Yeah, I would echo what Kyle mentioned. At the end of the day, I'm trying to, like, that's what I do. I help our companies fundraise. So I become a reference. I introduce them to a bunch of different funds. And, when a entrepreneur comes back to me, he asks, oh, why should I take this fund? And you want to be able to just be able to say, hey, you should take this fund because, or you should take my fund because of this. Just one singular, really strong competitive advantage focus. It could be around geography. It could be around technology, it could be around connections, etc. I think that's one. I think, as you're starting off too, I mean, if you can't demonstrate it by having an edge, maybe your edge is track record. So you should just go out there and hustle and demonstrate that you can get into really good deals and provide a lot of value. And, those references, as Cindy mentioned, references on companies and entrepreneurs, references on investors is the same thing, where if you can show the track record, you can point to people that say, hey, by the way, like, this is what, the CEO of this company said about, me and what I've done for them, then that'll help you sort of build up a brand.
Yeah. And then also, if you're interested on the investing side for crypto, you don't necessarily have to go and like raise a formalized fund. Luckily, this is actually an industry where the investment side is very accessible to the average person. So I definitely know people who wanted to get into regular VC, and then in terms of like doing angel and seed deals, it was a lot harder for them to like be able to get into those deals just because there's more, I guess, structure around raising those rounds. But then for crypto, I also know people who kind of want to dabble in investing in crypto, see like how good of an investor they are, et cetera. And it's very easy to actually get started with like a smaller pot of money and be able to just deploy just a little bit of capital every month or so into different crypto projects and just sort of like see how your investments perform. And so I would actually just say, like, there's almost no better industry to sort of like get started dabbling as an investor and try it out and see how you like it.
Great. Okay. I think we've answered most of the other questions here. All right, thank you guys. We'll wrap it up now. Thank you all so much for your time, for joining us, for your insights, and thank you to all the participants for your questions, for staying engaged, and for being here.
Thanks, guys.
All right, thank you.
All right, I think we're still live.